Good day, everyone. Today is... what is today? Today is October the 27th, 2025. It is Monday at 2:44 p.m. Eastern Standard Time as I am recording this. We are going to continue these short entries we're doing. We're sort of experimenting with a new sort of format here, right? So we had those two short reels. Then we did a sort of short... Okay, let's call it a short for Dan, short video entry that expanded on the topic, and then we're going to continue that forward. It's sort of a little experiment we're doing of attacking a topic and not making it an hour and 30-minute video, right? And doing a bunch of short little videos or reels and, sort of different formats to cover the topic, like a part 1, part 2, part 2A, part 2B. That's what this is. So this is part 2B. Okay. And I don't know, it's just a little experiment we have going with sort of a format, a new sort of format. I don't know if you'd call them chained short entries to a longer topic, or if others have done this before and we're just sort of expanding on that topic or discovering it late or what, but here it is, right? So anyways, yes, we are continuing that topic of learn your craft, sort of a way to explore sort of getting into, we'll call it I don't know what we should call it, maybe a precursor to folks who are looking to begin trading or thinking about trading. And we'll call it that, like a precursor. Before you start on any courses or playlists or anything like that, learn your craft, right? And what's involved in learning your craft of trading. We'll call this entry 2B. And we're calling it 2B because we're going to expand on the topic that we were talking about in the last very short video entry, and that is reasonable. Yes, I'm letting that word hang there for just a bit. Reasonable performance. And we were talking about performance and keeping track of records, but this is a massive topic. It's one we're going to put in the How to Begin series as well. And that playlist is very soon getting ready to get flushed out. But how to begin with investing and trading, you have to learn what's reasonable. We were talking about that in the last video entry. You just look at the S&P 500 index. You can scroll around here for premium members who have access to the spreadsheet. By the way, we've created a third quarter 2025 GTC sample portfolio spreadsheet with all of the tabs here at the bottom: S&P 500 index, GTC portfolio, long-term equity, fixed income, equity hybrid core, different pieces on that, the valuation book, short-term trading, right? Anyways, we've created a new sheet. We change it around from time to time so that there's a new link. Right? We don't want the link out there forever, so there's a new link. So we're going to be putting this on the new entries for the premium folks, but just know that there's a new link. Okay. Anyways, we were saying you can get a handle on what's reasonable performance, even just starting here at the S&P 500 index, because there is this massive thought out there of, can you beat the S&P 500 index, bro? To which I say, which program do you want? Right? What are you looking to do? Can I? Yes. Is the GTC sample portfolio looking to do that right now? No, it's looking for we have so much experience that, quite frankly, we get to pick our return profile. Do you want it linear? Do you want it absolute? We've talked about that in the past with premium members, but we're not looking to do that for all the reasons we've mentioned. But you can get a handle and start to get a handle on what's reasonable performance just by looking at a grid for the S&P 500 index. Right now it's got an annualized return, and that's if you go back to 2008 of 10.213%. That the average monthly return since 2003, however, is 0.96%. Maximum drawdown is negative 66%, which means your average drawdown is 6.5 times your annualized return. That's sort of a shorthand way of looking at the sort of risk you're taking on before you even get to Sharps and Sortinos and all of that we're not going to get to in this entry. Just that alone should tell you that anybody, listen, here, think about that. Think about this, right? We're just going to say this in this particular entry for reasonable performance. These yahoos coming along and claiming 250% per year performance. By the way, another little key there. For all the little furus out there that talk about how many dollars they make per day, no professional on planet Earth speaks in terms of dollars and cents. No one does that. We speak in terms of percentages. And of course, you need a larger account of some sort before percentages even begin to make sense. I've seen people on this side little tangent. I've seen people with like $100 account say, nah, bro, look here, 300% return. And it's like, well, I remember this from mathematics in like grade school. It's a lot easier to have a higher percent number when your dollar amount is next to nothing, right? So get it up around $10,000, $15,000, $20,000, bare minimum, then come to me and talk about percentages. Okay? But regardless, nobody talks in dollars and cents terms. We talk in terms of percentages and whether or not a particular strategy is scalable. In other words, that's all well and good. You did that on a little $30,000 account. Can you do it on $4 million? Can you do it on $50 million? And the real jump is, can you start to do it on $100 million to $300 million and more? Because that's when you start having scalability problems. For those people with experience, they know what I'm talking about, right? But this is something that retail traders are not exposed to. So, that little side tangent being said, think about it logically, okay? If the big goal, the big massive goal out there is to beat the S&P 500 index, and we'll have more to say about this in our How to Begin series, but if the big goal is to beat, can you beat the S&P 500 index? Let's scroll down. There it is. There's the 30-day cumulative return volatility, month over month, right? Can you beat it? Well, if it's averaging and annualizing, I should say, around 10% since 2008, somebody that comes along and tells you they can do 100% per year, you know what I mean? Come on, and we're not even getting yet to the speciality of looking for linear returns over absolute returns in situations where that's necessary, where people will actually leave you in the asset management world if your upside volatility gets too large. We're not even getting into that. We're just asking the simple question. If the S&P 500 index since 2008 is annualizing 10.213% with an average monthly return of 0.96%, and some yahoos coming along promising you 100% or 200% or 500% yearly returns, logic and common sense should tell you that something's off if the S&P is this great big benchmark to try to beat. Doesn't that make sense? Isn't that, sort of logical here a little bit? Now, that being said, and something we're going to get into in the How to Begin playlist or series, when it comes to performance and reasonable performance, there's a difference, okay, between what you'll see on the institutional databases and what you'll see in private prop, okay? I didn't say funded trading, and I didn't say open prop, because open prop is no longer what it was back, when I was a younger trader, back in 2003, 2004, 2007, right? I wouldn't go near what's called open prop now if you put a gun to my head, right? I view it as a legal scam, but that's just me. It's just our thoughts, not yours, right? Regardless, private prop is a totally different affair, where you set up a legal structure, you get capital partners, and you make sure everything. You generally want a lawyer on your team, as we have, and you make sure everything's above board and everything's in compliance, and you run it in a structure with private capital partners. Now, in that scenario, with experienced traders, right, and everything's above board from a legal standpoint, and private, qualifying word, private prop, Are returns generally a little bit higher than what you see in the institutional databases? Yes, absolutely they are. They can run 60% annualized to 80% annualized, returns. Because in a private prop situation, it's considered, listen, we're all adults here. We realize we're going to be pushing the pedal down to the metal a little bit. Everybody here is on board with that. Everybody on here reads every risk disclaimer. Everybody here in this little circle knows this is the big boy table, right? And if this is the big boy table, we're going to push that pedal down a little bit to try to get higher returns. Private prop. That's a different context. When you're looking at returns, you got to look, everything's in context. Okay? There's other contexts where I said before, where if your upside volatility gets too much, investors will actually leave you. That's more the asset management world, right? So what you see in the databases as far as reasonable performance, which we have pointed ones to there before, and I would like to thank Rob of Discovery Trading Group for sort of pointing that out, that can be a good teaching aid, right? That was his idea. What you see in the databases, private prop can go a little bit more. But that should give you some idea, just as a base starting point to begin. If you're going to learn this craft, please have reasonable expectations. And these 100% to 500% year return guys are generally the same guys when there's some sort of risk event that come crying. They're always the guys that come crying first, right? They've overleveraged, risk is tied to reward, and there's nothing in the universe that can that defy that rule, okay? So this has sort of been to be and just been our thoughts, not yours, for reasonable performance when it comes to learning your craft. Some things to think about, and has been just our thoughts that are good until they're canceled, and has been what it always is. It's simply been our thoughts, not yours, for whatever that date is. As always, stay safe, trade well, and remember that love doesn't cost a dime.